Hi, I'm Keith McCullough. Welcome. Today we're going to do a session called Hedge to Hedge, where we're going to talk to a world-class hedge fund manager by the name of Pieter Taselaar, who runs Lucerne. So the first thing that I wanted to do, Pieter, is kind of introduce you, and first of all, welcome.
Thank you, Keith.
And thanks for doing this. You're one of, not only are you, 2009 sailing, world sailing champion, but this year you've just done a great job from a performance perspective. There's a lot of people in the hedge fund community who haven't done just a fantastic job. I'd say that there's a pretty high low out there. Your numbers are up there. They have been for 3 years, 4 or 5 years now. What is it that you think that you're doing that's different?
Well, what we're doing that's different is we don't have a predetermined exposure level, either gross or net, that we are married to. Mm-hmm. So what my business partner Thijs and I are doing is we decided to, and we have specialized on European markets, primarily continental European markets, have gotten to know them very well, and basically pursue the best opportunities, long and short, that we can find, mm-hmm. without a lot of boxing in as to where we have to be and how large we have to be, etc.
And that's a big difference. I mean, and for those of you who don't know, when Pieter's saying that, targeting your gross level or your net exposure, a lot of hedge funds do that these days. They put themselves in a box because they're running too tight. In other words, their net exposure, their longs minus their shorts, is too tight. Pieter's basically saying that I don't really do that. I don't put myself in a box, because you seem to be much more comfortable going with your bottoms-up stock picking and your overall view. Would that be?
Well, that's right. If we go on a trip to Europe and we meet with all these CEOs and CFOs and we look at the macro landscape and we see a lot of long opportunities, then we will typically have a very high gross long book and exactly. a lot of long opportunities. And when things are bad and we see a lot of bad companies, we have a lot of short.
Imagine that. When things are bad, you short
That's right.
companies.
So.
Well, what's interesting about that, and your career has been very interesting, because you've been doing this you've had your fund for about 12 years.
That's correct.
You've seen a lot. You're a European hedge fund manager with a long bias. And how many years has Europe been not a good place from an economic perspective out of those 12 years?
Well, I think, put it in perspective, I've been doing this for 12 years.
Right.
And Europe has been, in those 12 years, has been in a recession for 8 years.
Oh, wonderful.
So I've known more bad times than good times.
But you seem like, again, your numbers are fantastic, and you seem to be finding the positive stories within negative economic backdrops.
Yeah, because you can, there's always something positive to find, even in bad times.
Well, hedge fund guys aren't supposed to say that.
Well, it's like, in bad times, when Europe was very bad in the crisis, the emerging markets did very well.
It's true.
So we found some European companies that had most of their sales in China or South Africa, Indonesia, and hardly any of their revenues out of Europe. And they were very cheap, because Europe was blowing up, Greece was blowing up, people were protesting in the street. But these companies, these global companies, were just racking up profits in these emerging markets. So we bought those companies on the cheap in 08, 09, and did very well with that, for example.
And on the same token, this year, it sounds like you were able to flip that upside down and say, hey, look, if commodities go down and emerging markets start to do poorly, I know what I'm going to get out of and short.
Well, yeah, and actually, we talked about that earlier in the year, right? You were one of the big advocates of sort of accelerating growth in the U.S., the Fed tapering, interest rates going up, or maybe past us, I don't know whether that is or not, but at the time that was the case. You saw those, you sort of saw it coming, the outflow out of the weak emerging markets. So money flowing out of Indonesia, flowing out of India, flowing out of Brazil. So again, what we decided to do is say, okay, we get out of a lot of companies that are based in Europe but have a lot of their revenues in those countries. Mm-hmm. Let's get out of them and or even short them.
So that's how you really don't put yourself in a box from a macro perspective either. It sounds like you really use macro to augment what you're doing from a bottoms up perspective.
Exactly. Well, what we do is basically we visit companies on a daily basis, multiple companies, and every company gives you a little bit of insight into what the economy is actually looking like. So, for instance, beginning of this year, what we started to see in Europe, we started talking to early cycle companies, and a very good example of those are temporary staffing companies, for instance, right? If you would grow your business here, you hire some, administrative assistants, you hire some accounting guys, whatever, but maybe you're not sure about the future yet, so you want to hire them on a temporary basis.
Right.
So we tracked very closely the numbers of these big European temporary staffers, and sort of in the second quarter of this year, the year-on-year numbers started to turn positive. So to us, that was not a definite sign that Europe was improving, but definitely it was an early sign that something was changing.
Yeah, where we weren't going into the thralls of hell. That would be the first type of a signal, is that things on the second derivative started to get better.
Exactly. Second derivative started first, getting less bad, and then it started improving.
Now, what's interesting about this, and this is kind of one of the big macro questions that I had for you, is at the same time the European Central Bank, which surprised me, it sounds like it may have surprised you with this rate cut, is still worried about things that may be on the outside or the periphery of this potential recovery. How do you wrestle with that, what the ECB is doing, and what your companies are doing?
Well, in a sort of perverse way, I mean, within Europe, what is very bad and the structural problems that Europe has, i.e., the periphery having a very high unemployment level, the banking system being fairly fragile in Spain and Greece and Italy, may be very good for the rest of Europe, because it sort of forces the ECB to keep rates low, because of this structural, maybe not structural, but fairly long-term unemployment level in Spain and Italy, etc., and the periphery and the fragile banking system, the ECB is sort of forced to keep rates lower for longer. And that's not necessarily what Germany needs or what the rest of Europe needs, because actually if you travel around, we talked about this before, if you go to Munich or to Hamburg, you talk to the companies there, there's negative unemployment in a lot of these places.
It's amazing that comment, because people, particularly U.S. investors, and I get this a lot, folks, because people are so dogmatically focused on the U.S., they superimpose their views about what's happening in the U.S., particularly from an employment perspective, on what's happening across Europe, and they call that every single country. But the German employment situation, it sounds like, is about as good as it's been, is it not?
Yeah, it's getting very tight, as a matter of fact.
Like
it's very tight. It's getting very tight, and what you now see is actually you start to see wage inflation,
which is quite good.
So you saw about annualized with the latest hikes in wages, you see about 4% annualized wage growth, which is good for consumption. Which is good for the economy. So again, sort of in a strange way, the weakness of the periphery is an engine for the core of Europe, which will in the end help all of Europe.
It has to. I mean, it has to at the end. There has to be some kind of a cohesive cycle in motion here.
Yeah.
And it feels like if people are still fighting that last war, if Europe is in perpetual crisis, I mean, like you said, 8 out of the 12 years you've run money, it has been a crisis.
Right.
So what are the odds, and how do you handicap this being a longer-term cycle, and where are we in that cycle if we say there's early, mid, or late cycle in Europe as a whole?
I would say we are very, very, very early in an expansionary cycle.
From a growth cycle.
Yeah, from a growth cycle. Because just to give you a couple of numbers, and some basic numbers that everybody will understand. In 2007, about 17 million cars were sold in Europe. Last year, it dropped to 10.5 million.
Was that the low?
That was the low. So we are in car sales, and it differs a little bit from country to country, but in terms of annual car sales in countries like France, in Spain, in Italy, even in the UK, even in Germany, you're back to levels that we saw last in the 1970s, in 1972, 1975.
Horrible time.
Yeah. Horrible time. So, so you had a drop from 17 to 10.5. I mean, are you still going to drop, by those amounts? No, you're not, because people, the average age of a car on the road in Germany is the highest it's ever been.
Yeah,
it's 10.5 years. So people have to buy new cars.
It's such a basic consumption pattern, really.
Yeah.
So if the world isn't going to end, and you believe that basic consumption patterns occur, like household formation and auto purchases, I mean, we show this auto sales chart. It shocks me, actually, because when you say we're really, really early, I mean, we literally have only had a couple positive months. So if autos, is that the bull case for Europe? If you were to kind of put, not that that's all of Europe, but if auto sales go from 10, they went from 17, they go to 10, and then they go to 12, I mean, that's quite a healthy environment for somebody who's manufacturing autos.
That's 20% growth for an auto manufacturer, and that can happen. Everybody now assumes that that Europe will be in a very slow growth path for forever. And we're looking at a lot of industries, and probably for the economy as a whole that will be the case because there are some structural issues. But there are pockets like the automotive industry, housing, and that's a late cycle industry. We don't see an improvement in housing yet. But housing starts are at a 30-year low.
Yeah,
I mean, the country where I was born and raised in the Netherlands, you need about 90,000 to 100,000 homes a year just to keep up with demand. And the new homes built now are 10,000 a year.
Wow.
So you can imagine what the delta, the change will be massive once it changes.
When you say this, and you and I talk about this a lot, but it's almost like where the U.S. was a year ago. Really, I mean, you had a depressed level of housing supply versus a just run-of-the-mill recovery back to above zero. I mean, household formation went positive, U.S. birth rates went positive, and there weren't enough homes to sufficiently service that demand.
Yeah.
So Europe's just like happening a little later, so that's why you call it early.
Yeah, I would say it's probably even where the U.S. was 2 years ago.
2 years ago?
Yeah,
really?
2 years ago. And and I've done this for 12 years, and of course emerging markets have become a much more important part of the equation, especially China. But the U.S. is still a big part of the world economy.
Right.
And with the U.S. improving, inevitably Europe will improve.
Exactly. But it's hard for people to see that because they haven't seen that. I mean, if you said Pieter says he's been doing this for 12 years. Obviously, he's been doing it for longer. That he's been running his fund for 12 years. Used to be on the sell side. Right. And like a lot of us, the sell side's really changed too, and the way that you kind of think about doing research in these economies and the way that people come to conclusions. Like, how much of an opportunity is that for somebody like you that's just pounding the pavement, seeing these companies versus where we were 10, 12, 15, 30 years ago from a research perspective? Who knows what kind of edge you can really attain?
I think Europe is a little different than the U.S. in that respect also. I think Europe, just to begin with, there's not a big equity culture. If you look at the average German investor, average French investor, they typically are not that interested in the stock market, and they don't own any stocks.
They're not maniacal about it. They don't wake up watching these crazy TV channels. It's
the CNBC is not on all day long in the office, etc. No,
that's not what they do.
No, that's not what they do.
That's probably a good thing.
That's not. It's a better quality of life, probably. Less stressful. So, and then you basically on top of that you layer the fact that we've been in a horrible financial crisis. So the few smart guys that did actually analyze stocks and did their valuation work and analysis, they have left the business.
Yeah.
So there aren't that many people around that are still sort of what you say, pounding the pavement and rolling up their sleeves.
When I go to Europe to do meetings, typically I'll go to Europe and it's like a US-based company that has an office in London. That's pretty typical. A lot of young people.
Yeah.
That like 35 to 50-year-old set, not a lot of it. So it's almost like we've eviscerated almost like a base of research. Do you think that that's fair?
I think that's a fair thing to say. You eviscerated about 15 years of experience.
Wow. And
there's a gap. And then the young guys that you're talking about, they all want to be macro guys. They all want to be masters of the universe, and they think very black or white. And it's always good to have a macro overlay, even for bottom-up stock pickers like ourselves. But in the end, you have to invest, in our view, in stocks that really generate good cash flow, can sustain that cash flow, and grow that cash flow over time. And you buy them on the long side at good valuation levels. And you got to do the work for that.
That's what you and Thijs are like. Thijs is Pieter's partner, are just so disciplined at. I mean, that is what you do, and come high hell or low water, and not to use that analogy given you're a sailing guy, but I mean, that really is hard to do in this kind of a momentum investing environment, is it not?
Yeah, it is, but it also comes back to your previous point where we have been able to squeeze out positive performance even in the bad times because we always buy companies that we actually believe in and that can, weather the storm.
Yeah.
Again, to use the sailing analogy, but that have the balance sheet and the cash flow and the quality management to actually make it through the bad times.
No, that's like I can always tell with clients when our analyst is talking to you guys that they better have their game face on, because you're really into understanding where is this company from a margin perspective, where's the upside. I want to basically stay away from big downside. Yeah. That loss aversion that you have is also pretty important. Is that something that
we have no tolerance for permanent losses. So let's say we don't want to buy bad companies and suddenly they have to come out with a rescue rights issue, or there's new disruptive technologies coming in destroying their business. We don't get involved in those kind of situations.
No, it's like meat and potatoes, businesses you can understand. It's a real kind of value investor's approach.
Very boring.
Yeah, but it works.
But stay the course.
It's interesting. The other thing that I was going to ask you, and maybe a lot of U.S. investors in particular worry about valuation in the stock market, because they should. I mean, the S&P's multiple, the S&P's at all-time peaks in terms of S&P 500 margins. How does Europe look? Is it expensive? Are the margins high or low?
It's a good question. Again, if you take the market as an aggregate, and again, it would be a point, I'm biased there, of course, looking at Europe, but as a matter of fact, I've always thought that Europe, from a top-down perspective, does not look, particularly cheap, or is going to grow faster than the rest of the world, or whatever.
The growth rates are lower.
Yeah, we just pick the right stocks on the long and short side. But this is probably the first time in my 12 years that I say, well, Europe actually looks very cheap, given that we're at the beginning of one of these upcycles. And if you believe that upcycle will continue, which we believe actually, because now the later cycle companies are actually starting to throw more positive numbers. But European margins on the whole are at a 10-year low. So
I think that would surprise a lot of people. I mean, margins at a 10-year low, if you're to say in the aggregate. I mean, in the U.S., we're nowhere in the area code of a 10-year low. You're at an all-time high in margin.
All-time high, yes.
So you get margin expansion and the earnings base.
Just to give you, a couple of statistics. I mean, it's very simplistic, but it's sort of an interesting way of looking at it. In the U.S., on aggregate, profits are 20% above where they were in 2007. Okay. In Europe, we're still 20 to 25% below 2007. Now, given that fact that we're 25% below the level of 2007, plus the fact that we're sort of, at these low levels of demand, and companies have really cut back in their cost base, there's a lot of operational leverage. And if we were to go back to 2007 levels, which I think is very reasonable to assume.
Because that's just a mean reversion assumption. That's why you're using it.
That's just, you just need car sales, for instance, to go back to 12, 13 million.
But that's why you're using, I mean, you're saying it's a simplistic analogy, but the reality is that not a lot of people use mean reversion as a baseline way to kind of be risk averse. And you're saying, look, go back to the baseline. The U.S. is 20% above the baseline. Europe's 25% below. So I'm just playing for that 25% back to where we were.
Play for the 25%, and then you only need you don't need demand to go back to 2007 levels
because costs are low.
Because costs are low.
How much lower?
So
how do you think
it depends, but
like if you say a good German company who cut costs, or a good company that you own, like how much
they would have cut their workforce probably on average by 15%.
Huge.
It's huge.
Well, that's why unemployment's high.
They would have automated a lot of their production. They're running very, very efficiently right now. So the operational leverage, for instance, if you look at, I was talking to a forklift truck manufacturer. The thing that moves stuff around in warehouses, right? Yeah. So they went from 5 factories in Germany to 2 factories. Highly automated, cut 40% of their workforce, right? And they've been dealing with 5% decline in demand every year for the last 5 years.
Brutal.
Boom, 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 brutal. Stock is trading at 10 times earnings, and now suddenly they see demand picking up 5-10%.
10 times trough earnings.
Trough earnings, yeah. And now they see it suddenly picking up.
How big is a company like that?
And they're running at 70% capacity utilization. So the interesting thing is, so if you mean revert, right? So you could see demand picking up by another 20%. Yeah. A lot of that is going down to the bottom line because they don't have to invest.
No, it's just
in capacity.
Pure economic leverage.
Pure economic.
And one other question on that, like how big of a company in market cap would something like that be? A big old boring company like that?
Well, we don't. Because
you don't invest in microcaps and.
We don't invest in microcaps. On the other hand, we also don't invest in the mega caps. So we don't invest in the Vodafones and the stocks that everybody's chasing and everybody knows. So the typical sort of asymmetrical cases where we see sort of 10% downside, 50% upside. They're typically sort of in the $3 to $8 billion range.
Wow!
Because that's exactly where all those guys that used to analyze them, they've disappeared, and they're not looking at them anymore.
Which is why I think what Pieter does is just really the fantastic opportunity of it all. Because in the U.S. you have way more hedge fund managers, you have way more coverage on all these ideas. You don't have that. I mean, if you have a company with $5 billion in market cap, you're going to have 25, 30 analysts following it. Yeah. There's very little edge. Yeah. I mean, if some of these people do have edge, they're going to potentially go to jail for that edge. Yeah. I mean, it's like, it's a very unique environment that you find yourself in, and that alone should at least have something to say about how well you've done.
Yeah. And then I was just thinking while you were, to come back to your previous question about, Europe being cheap versus the U.S., go back to that 07 profit level again. If we get there, Europe is actually trading at 9 times that level earnings.
And the U.S. is trading like,
what is it, 15, 16,
yeah,
17?
You could argue even 18, 20 times earnings.
Yeah.
I mean, so that's the otother thing. I mean, if the U.S. Federal Reserve, which I've been fairly critical of, if they really can't land the plane, if we start to slow here in the U.S. again, Europe is to me, the most obvious place to allocate capital. Yeah. So strategies like yours should continue to do quite well. Yeah. Yeah. So. Well, it's great to have an opportunity to speak to you about all these things. It's good to kind of bring to life some of the discussions that we have just on the phone, behind the scenes. It's just hopefully to all of you, that's the kind of thing that you're looking for. This is Pieter Taselaar, obviously, who runs the Lucerne hedge fund out of Greenwich, Connecticut. Actually, they're based in Greenwich, so they're U.S.-based European long-short hedge fund. He and his partner Tice are very good at what they do, and I'm just quite happy to be able to introduce them to you. So thank you. I'm Keith McCullough at HedgeyeTV. At Keith McCullough is my Twitter handle, at HedgeyeTV. If you have any questions, compliments, concerns, anything at all, just tweet me. Thanks.